Financial Planner. Follow us on YouTube.
Phil has been in the investment business since 1962. He was the managing director of Fox Asset Management, a subsidiary of Easton Vance at Fox. Phil was on the investment committee, the strategy committee, and the management committee. Phil was the vice president of Payne Weber, now known as UBS. This was the investment consulting services. Worked with financial advisors nationwide, setting investment policy, asset allocation, hiring outside managers, and monitoring results. Phil was the vice president consulting services for Merrill Lynch. Phil, welcome to the Spotlight.
Glad to be here, Dave.
Hey, thanks for being here. And let's start off with the economy. And we know the corporate media is out there and they're telling us how great it is, how fantastic the economy is doing. And of course, they always point to the stock market. I wanted to get your take on the economy, on how it's really doing since 2008. Has it gotten stronger? Is it weaker? What do you see happening in the economy?
Well, since 2008, I'd have to say the economy is somewhat better than it was at the bottom of 2008, because we were about to, collapse. Had TARP not happened and had the Fed not intervened with massive money printing, I think that the United States would be a very different country today. But that aside, they did that. And the economy just still bumping along. Maybe we're growing at 2%, and that's about where we can go. A famous investor, Mark Yusko of Morgan Creek Asset Management, always says the GDP is calculated by the growth of your labor force, which is in the United States right now at 0.05 back to 1935 levels, and productivity, which is about 1%. So we're at about 1.5%, 2%, and that's where we are. Despite what the president, what Congress, what CNBC, et cetera, says, we're growing about 2%. GDP now, Federal Reserve of Atlanta just lowered their estimate for the third quarter, 2.2% annualized. A month ago, we were at 4%. So every quarter we go through this nonsense of we're going to grow at 4% and we're back at 2%. So, and if you just look at the data, you got retail stores closing, you got restaurants closing, you got usage of restaurants down. So all the statistics that I look at, for example, real earnings based on August data, real earnings are down about 7% on an annualized basis. Real retail sales are down about 7% on an annualized basis. Housing starts are down about 10% on an annualized basis. Industrial production's down about 10% on an annualized basis. And that doesn't even give any effect to the hurricanes, which we had. And we really don't know what the economic impact is of these hurricanes. Clearly right now we're in a lull, but the cost of rebuilding, where is that money going to come from?
Do you think it's possible to rebuild the economy at this point, or do you think we're too far gone?
Well, at $20 trillion in debt and rising rapidly, I just saw a statistic recently that the deficit is starting to rise again for the first time since 2009. In 2009, we were probably at around a little over $1 trillion deficit. And it got down to sort of like $500 billion range. And now we're back at the 600 to 650 range and going higher again. Unless, we can keep borrowing forever, I think sooner or later this has got to stop.
Now, we've seen Toys R Us. They just declared bankruptcy, Chapter 11, and they're saying that Best Buy might be the next big chain to go. When you look at the retail market, I mean, to me, it looks like a retail apocalypse. Why, in your opinion, why is this happening right now? Why are all these retail chains, I think there's 25 of them already, that have declared bankruptcy? Why is this happening right now?
Well, number one, I mean, clearly Amazon is having an effect on the whole retail mentality of the average consumer. It's much easier to go on your phone or go on your computer and order something and get it in the mail the next day than go to a store. But I think that probably, if you think about it on a broader sense, there's too many stores. Most of the stores have the same exact merchandise, and they're all fighting for the same consumer dollar. So if you take the average consumer that starts buying on the internet instead of going to the stores, sooner or later we have too many stores. I remember a few months ago, they had a statistic, somebody pointed out, that how many store closings the major chains are going to go through. And it was in the thousands around the country. Second part, and Toys R Us is a prime example of this. This is a company that was taken private, loaded up with debt, and now we have an over-leveraged problem, and they can't meet their obligations. And that's all these stores are in the same boat, especially the ones that went bankrupt. According to Fitch a few months ago, in the next 12 months, they expect Sears, Charming Charlie, 99 Cent Only, Gymboree, and others to file for bankruptcy. They didn't even have Toys R Us on their list, but here we are. And now people are saying, well, the fact that Toys R Us are going bankrupt may bankrupt some of their suppliers, like Mattel and Hasbro and all these other companies. So the consumer has taken on a tremendous amount of debt over the last several years because wage growth is stagnant. And without wage growth, the consumer really doesn't have a lot of excess money other than to take on more debt. And recently, we've started to see delinquencies rise. We've seen delinquencies rise in auto loans. And a typical auto loan now is 72 months, 6 years. The typical car doesn't last 6 years. We've seen delinquencies rise in student loans. We've seen delinquencies rise in credit card loans. And with interest rates at all-time lows, basically zero, maybe a little above zero, but basically zero, what happens if this so-called Fed is going to march on and raise interest rates? I don't see it happening because the economy just cannot stand a rise in interest rates right now. And think about the federal government. At $20 trillion debt, if interest go up by 1%, that's a $200 billion hit to the economy. So sooner or later, something is going to have to give. And, historically, whenever we've had these huge debt problems, we have some sort of debt jubilee or defaults or forgiveness or whatever you want to call it, but it all amounts to the same thing, that we ultimately have a debt deflation and, everything gets wiped out and we basically start all over again. But during that period, there's a tremendous amount of pain and suffering.
Now, you mentioned the Fed and them raising interest rates, and they're also talking about unwinding their balance sheet. Do you think this is actually possible? I mean, you said the interest rates, if they raise interest rates, we're going to be in a big trouble. If they raise interest rates, doesn't that also hit the real estate market?
Absolutely. I think that, if you just look at even corporations that have floating rate debt or short-term debt, which they've been using in the markets over the last couple of years to fund their operations, if rates go up, they will be squeezed to a point where they can't afford it and eventually will go bankrupt or, out of business or be kept alive in some crazy fashion. So we'll have zombie corporations that just sort of limp along and do absolutely no good. As far as the thought of the Fed unwinding, they will probably announce something today. Even though we stopped QE a few years ago, we were still buying about $30 billion a month of bonds just to replace the bonds that were maturing. So we never reduced the balance sheet as bonds matured. We kept adding new bonds to the mix. So now they're going to try to theoretically unwind the balance sheet, which is about $4.5 trillion now. And, they are probably going to announce they're going to cut their buying every month by about $1 billion, which is baby steps. However, at the first sign of economic problems or a slowdown in the economy or recession forecasts start to go up, what's going to happen is they're going to go back to QE4 and QE5, QE6. We are never going to unwind this balance sheet, in my opinion. So, it's nice. It sounds good. CNBC keeps talking about it every day, but it's not going to happen.
How can all this debt be sustained? How can they keep the economy running? What are they going to do?
Eventually, I think the central banks will lose power because people will no longer believe that, they're actually doing something positive. Where printing money will once again become a major negative. We've had historical examples of what printing money ultimately leads to. We've had Germany in the 1920s. We've had Zimbabwe recently, where you have $1 trillion notes, where people weigh money to get a price. They don't say, give me $5. You put, 10 pounds of paper on a scale, and that's $5. And that's where we're headed, in my opinion.
So you mentioned the stock market just before, and you mentioned it, as we've seen, it's continually moving up and up and up, and corporations come out saying that their earnings are pretty darn good. And when you look at the market and you continually see it move up and you see the corporations reporting their earnings, is this a bubble that we're in? Do you think the stock market is in a bubble?
Well, I think it's in a bubble, but I would rather, quote some more well-known people than me. Bill Gross made a comment about a month ago. Bill Gross, the former chairman of PIMCO and now with Janus, a highly leveraged system is like riding a truckload of nitro on a bumpy road. And just recently, Seth Klarman, the CEO of Baupost, a $30 billion hedge fund, probably one of the most successful investors of all time. I am more worried about the world more broadly than I've ever been in my career. And today on CBS, Michael Bloomberg was asked a question about, the market keeps going up. And they asked him, why do you think the market is going up? Michael Bloomberg, under anybody's guess, is a very successful investor, entrepreneur, etc. He said, I have absolutely no idea. I cannot for the life of me understand why the market keeps going up. Our economy has some real challenges. The infrastructure is falling apart. We're destroying jobs with technology. We are keeping the best and brightest from around the world from coming to America to create new jobs and create new businesses. So, and I learned over my 50 years in the business, when very smart people start to worry, I think you should start to worry. Now, the fact that the market goes up, in 2000, we had the same problem. We had ridiculous, the markets were going to go up. How many eyes people were looking at the internet. We had crazy valuations. Now valuations are said by some to be the highest in history. It went up until it stopped. March of 2000, the NASDAQ hit its high, and 2 years later, the NASDAQ was down 80%. If you had bought back in 1929 at the high, and you looked at your portfolio, you didn't break even until 1954. So we could be facing a similar situation as that again, in my opinion.
So we mentioned the economy, and you said, we've had some type of improvement because of the Fed. They stepped in and they pushed stimulus and they pumped everything back up. Now, when they did this, did they actually create a true recovery of the economy? When you look around from your research, is this recovery that we're in? They brought unemployment down to 4.7%. A lot of people say this is completely manipulated. I believe these numbers are completely manipulated. Do you think this is a true recovery of the economy?
No, I think that, in my lifetime, I've always said we always have inflation of one form or another. We either have real inflation where prices go up, or we have asset inflation where assets go up. So basically what they've done is improve the stock market. So those at the upper end of the income scale and of the wealth levels improve. So, basically they improved the wealth effect of the top 1%, 5%, whatever number you want to use. But the average guy in the ground that has no assets, he's struggling just as much as he was struggling in 2009. I mean, the job market may be somewhat better today than it was in 2009, but clearly not enough to drive wages up, which is what people use to buy goods.
Now, we understand that the dollar is used around the world and out in the Middle East, and with some of the South American countries, they use the dollar on oil, and it's called the petrodollar. China came out and they did something very interesting. They took the yuan and they put future contracts of oil on the yuan, and I think some people said it's backed by gold. And this is the first time since, I think, the 70s, when we came off the gold standard and we went onto the petrodollar system, that this has been done. Is this going to be a problem for the United States and the economy of the United States because of what China just did?
Well, it's just about formulating, and I know they've made some trades in yuan. I think it's going to be a major problem. Just think about this. Every country in the world that was buying oil based on an agreement that Henry Kissinger made with the King of Saudi in the early 70s, that the Saudis would price oil in dollars and we would defend them in exchange for our defending the kingdom. Now, since then, every country in the world, whether they liked us or hated us or whatever, had to buy dollars. They had to get dollars one way or another to pay for oil. Now, take countries like Iran that, clearly we have a problem with. I don't want to go into politics, but we have a problem with. And we were able to put sanctions on them and basically prohibit them from actually selling oil anywhere because they couldn't participate in the banking system and they couldn't use dollars. But recently they made trades with Russia, like a barter deal. They traded oil for goods. They did it with China. Now they will clearly want to embrace this yuan for gold kind of alternative. Russia, another country that is very large oil producer, will also wants to get off the dollar because it takes away our hammer from holding them back economically through sanctions. So they could trade in dollars. Now, Venezuela just recently said that, we put sanctions on them. They're going to trade in yuan, and they're actually quoting oil in yuan now. Now, if you look at the number of oil producers, you got Russia, number 2, probably Iran, number 3 or 4, and Venezuela with the largest oil reserves in the world, now using another currency other than dollars. I think that that's going to have a material effect on the U.S. dollar. And, clearly the U.S. dollar has been sinking lately. And even with the dollar sinking, we still can't improve our exports. We still can't improve our economy. So I think it's going to be, it's going to take some time, but I think that this is going to have a material effect on the U.S. economy and, commodities around the world. So, this is one to, watch carefully over the next, several months and years. We got the Chinese Party Congress coming up in October, and they're going to have like a real regime change. The people at the top are staying, but they've really reshuffled the deck. So, that's going to be another interesting thing to watch in the next several months after they have their party Congress and consolidate power in Xi Jinping and some of his top deputies. But, there is clearly an economic war that could erupt out of this whole deal.
So when you are saying, watch this in the next couple of months or years, and this could hurt the dollar, I just want you to explain to the people who are listening to this, what do you think will happen here in the United States if more countries decide let's trade in the yuan. Let's not use the dollar. Let's say Saudi Arabia decides to do this. Let's say Iraq decides to do this, and all the oil producing countries decide, something, we're not going to use the dollar. We're going to use the yuan just like all the other countries because this is going to be better for our country. In your opinion, what do you think is going to happen here in the United States? And if you can, try to break it down so everyone can understand what is going to happen.
Well, clearly, one of the big markets for our treasury debt is, these overseas countries that have built up reserves in dollars, through borrowing at European, banks in dollars, etc. Now they won't have to have those dollars in reserve. They won't have to bid up the dollar. So the dollar will get cheaper on a comparative currency basis. And therefore, anything that we import will start to cost more. If today you could buy a coat from China at $10 and the dollar decreases by 10%, you're now going to have to pay $11 for that coat. So I think inflation will rise, and then people will no longer trust the dollar as the reserve currency of the world by itself, and it will probably start to share the stage with the yuan or gold, which I think is probably where most people will use, because gold has been around for 5,000 years as a store of value and as a money substitute. When Nixon went off the dollar, off the gold standard, he basically said, I'm going to give you a piece of paper, and you have, that piece of paper is backed by the full faith and credit of the United States, whatever that means. And up until now, nobody has questioned that. But, if you go back in history and you look at when Britain was the reserve currency of the world, and now it's just an afterthought. It's still around, the British pound, and still used by, a lot of people. But, Britain has, once Britannia ruled the seas, and now it's just another country struggling to keep its existence. So I think that we're going to get inflation going higher, and economic activity in the United States will start to go down.
So you're saying that our way of life most likely will change during this period? And when I say our way of life, what are you envisioning? What do you see happening? Today everyone's, driving around semi-nice cars, or the older population, they're driving around very nice cars. They went through the system, they have their retirement, they have their pensions, they have their investments. Should these people be worried about what's coming?
Well, one of the things I warn people, take the senior community. We have about 10,000 people a day turning 65, probably until the late 2020s. And we have 1.5 million or thereabouts turning 70 every year for the next 15 years. So most of those people are finished in their earning part of their life. Now whatever they've accumulated, and that's got to take them to the end. And historically, when people became senior citizens, they started to de-risk their overall portfolio, lowering down their equity allocation and putting more of that money towards bonds and short-term kinds of securities. But what the Federal Reserve has done has punished these kinds of thinking. It's punished these kinds of investments. And they're basically telling you, if you want a return, you have to go out on the risk spectrum. But I don't think that the average person out there really understands what risk means at age 70. For example, if we started to go back and thought about if we had a retracement of the gain since 2009, and let's say we had just an ordinary bear market, the market would go down about 20 some odd percent. Nothing out of the ordinary, but basically that would wipe out gains of the last 3 years. And let's assume that that's as low as it goes, and we could start to regrow back at about 6%. It would take you 4 years to get back to where you are today without depleting any of your principal. Assuming that you didn't have to deplete any of your principal. That's 7 years of investment returns gone. At age 70, that's a big hit. Now, let's say we go into a recession, where the average recession, the market has gone down about 35%. That would take you about 8 years of gains back, and it would take you about 12 years. So that would be about 20 years of investment returns wiped out. So for senior citizens, they're forced to look between a rock and a hard place. Either I accept no real return or a relatively low return on my money, but many would say it's better to get a return of your money than a return on your money. And people are buying things today, they have no clue as to what they even own. And, one of the big movements over the last several years has been a move into exchange-traded funds, ETFs, which have garnered hundreds of billions of dollars over the last several years based on the fact that they produce returns equal to the market, and the fees for owning these ETFs are, lower. So it's the best of all worlds. I'm getting something for basically nothing. But the world doesn't really work that way. And what's happened is people buy these ETFs not understanding how these ETFs work. I'll just use a simple example of the S&P 500. If you buy the ETF of the S&P 500, you're buying the weightings of the S&P 500. So every time you put $1 into an ETF of the S&P 500, they replicate the S&P 500. They do adjust for float. For example, a lot of Microsoft stock, which is one of the biggest stocks in the S&P 500, is privately owned by Bill Gates and Steve Ballmer and others. So they subtract the shares outstanding from that. So they have a float adjusted weighting. And basically, so they keep buying the same stocks over and over and over again, pushing up the same stocks over and over and over again, which is why you have the S&P 500 making new highs again every day. So it's a very small number of stocks that are really pushing the market. And when this reverses, and it will reverse, I can't, bells don't ring at the top or the bottom, but when this reverses, it'll be an avalanche. I think there will be days where they won't be able to open the market because of the volume of sell orders. In 1987, on October, I think it was 21st, it was a Monday, and I'll never forget it because a friend of mine got married that Saturday and went away to Italy on a honeymoon, and they didn't have any communication, and basically they were wiped out by that day. The market went down 20% on that day because of the volume of sell orders, because of this so-called portfolio insurance, which didn't work back then. And this is what's going to happen now right now, the typical investor, and according to Market Vein, is 70% bullish, which again is, historical level. And whenever we get to 70% bullish, something bad happens. You're going to get, instead of 1-800 get me in, you're going to have 1-800 get me out. And with these robo-advisors, I think chaos will take place.
And those people that are depending on their pensions, what do you think is going to happen in that market? Or people are expecting to get their pensions, what do you think is going to happen there?
Well, pensions are a real problem. This is an area where I used to spend a lot of time. I had many clients that were defined benefit pension plans. And over the last 25 years, clearly many companies that got their plans fully funded closed down the defined benefit plan, annuitized the stakeholders, and went to some sort of defined contribution 401k kind of plan. Most of the defined benefit plans today, the ones that are in existence, are underfunded by huge amounts. and they cannot make it up in my scenario. They're also over leveraged to equities. And, if equities, let's assume we go through a, 2000 to 2002, where the NASDAQ goes down 80% again. These pension funds will get so underfunded that they will have to, close down one way or another. I'm watching Puerto Rico as an example because they can't pay their bonds and they can't pay their pensions. So, they're going to have to make a deal of some sort, whether the deal is 50 cents on a dollar, 30 cents on a dollar, 60 cents on a dollar. I can't answer that. But clearly the state pension funds, places like New Jersey, Illinois, Kentucky, and others are severely underfunded. And if you look at their assumed returns that they build into their models, they're still about 6 or 7%. And if you think about bonds earning 2% or less and stocks earning 6%, and if you have a normal 60-40 allocation, you can't get to 7%. So every year that underfunding gets worse. I don't know when the day of reckoning is coming, whether it's 2020, 2022, 2023. At some point, pensioners will be asked to take less. Now, on the jointly trustee plan, the Taft-Hartley plans, like the Teamsters and the bricklayers, etc., I think there are something like 15 plans right now that have filed in the United States Department of Treasury asking for ways to modify benefits. Modifying benefits means you're not getting 100 cents on the dollar. So if you were assuming you were going to get $10,000 a year, just to throw out a number, you might have to accept 7 or 6 or 5 or whatever number. I clearly think that that's going to affect people's lifestyles. And at a time in their life when they're looking at their golden years, hoping to sail into the sunset, they're going to be scrounging around. How am I going to make my next meal? This is a very troubling thing for me personally to think about and talk about the people that are senior citizens, because I'm afraid that too many of them don't realize what's coming down the pike.
So in your opinion, what should people do to protect themselves from what is coming, from this, crash?
Well, I think that, everybody should have at least 10 to 15% of their portfolio in gold. I would have gold bullion, and if you want to own the stocks, that's okay. For a short time, they're going to be okay. But I think that gold will always be a store of value. And, although right now, gold is trading about 1,300 roughly, it's still in a corrective mode from, down from about 1,900 a few years ago. But I think that gold will eventually, go up in price, and it will always be a store of value. The other thing is I would start to look for relatively safe investments on a short-term basis by, short-term bonds of the United States Treasury or of any other, country that has, a reasonable economic plan. I mean, if you go to Europe today, in many countries, short-term bonds still have negative interest rates. So you can't do that. And the other thing is another way of buying, you have to buy insurance. And I would sort of think that people should ask their financial advisor about buying some protection if the market goes down. Buying puts on the S&P or any stock you want to buy that premiums may be high, or, writing calls on your position if you own stocks and, in case something really bad happens, just a way of buying insurance. And I always look at insurance and people say to me, well, what happens if nothing happens? It cost me money and I should have stayed in the market, etc. And I ask the people this question. Do you think about buying homeowners insurance just to protect yourself in case your house burns down? And the fact that it doesn't burn down, you say, I'm not going to buy my insurance next year? That's the same sort of mentality and concept that I'm talking about. I think people have to buy insurance just to prevent calamity beyond anything they think can happen. And that's sort of the position I think we're in. We're facing a long period of underperformance and potentially chaos.
Phil Sloan, thank you very much for being on the spotlight. I really appreciate it. Thank you very much.